Okay. Good evening, Ken. This is Chris Hunter here in Farmington, New Mexico, and you're Ken Dupre, located where, Ken?
Good evening. And I'm located in, actually, Pittsburgh, Pennsylvania.
Are you actually in the city then?
The south end of it, yes.
South end of it, all right. Well, have spent many a day in Pittsburgh, one or two money management firms headquartered there, including Muhlenkamp, just outside of town, and I'm so glad you've been able to take some time out on a Labor Day evening to speak with the Finance 425 and 525 class. As I advance the slideshow here, Ken, I'd like to have you share just a little bit about yourself and what you do at Muhlenkamp, and who the heck is Muhlenkamp, would you please?
Muhlenkamp is a mutual fund company. We are headquartered up in Cranberry, Pennsylvania, which is basically North Pittsburgh. And we have about $700 million under management. We only know how to manage money one way for the most, and we don't generally in our approach, we like to find growing companies at a reasonable price.
Okay, and Ken, your role there is that of a portfolio manager and analyst, is that correct?
Yes, and I'm a generalist, although I have done a lot of work in the energy and finance and actually home building areas and auto. However, for us, I would be the energy person you'd want to talk to.
So at Muhlenkamp with $700 million under management, you folks then take different segments and divide them up across your team. Is that how that works?
For the most part, yes, but we are all generalists, and if we can go to wherever we think we can find value and where our interests take us, which is one of the strengths of what we do.
Okay. Well, let's find out a little bit more about what you do. Our students are busy learning about valuation within oil companies and energy companies. In a general way, one of the things the class has looked at again is the difference between fundamental analysis and technical analysis, with technical analysis relying a lot on stock charting and momentum.
Yes.
What approach do you guys take?
We clearly are much more fundamentally based. Ron Muhlenkamp, my boss and our portfolio manager for the fund, does have a tendency to somewhat use technical analysis. We usually like to see he usually likes to see the turns in the companies and the stocks before he buys, as opposed to try to bottom fish and catch the bottom or the top for that matter. He usually waits till a company turns and starts heading down before he sells. However,
go ahead, Ken.
At the very root, we are valuation based, and we do look for growing companies at a reasonable price.
So would you make some of your decisions in terms of buying stocks or being in cash on the basis of the general economy? Does that play a role even before you look at the specifics of an oil or gas company?
Yes, we do have, we go both ways. The analysts help us do a bottom-up approach, just sifting through companies. Ron focuses more on the big picture. And yes, our allocation is determined by between stocks, bonds, and cash, which we can go to any and all. And it's determined by what we think the after-tax, after-inflation returns will be and where we can find the better returns.
So once you start to make the decision amongst the three different types of places you can park your clients' money, which was cash, bonds, or stock, if you decide that stock might make sense, how do you then look at what industries to select?
That it's a little bit of everything. Again, top down and bottom up. We're always sifting through companies. We have screens we go through. We look for our basic beginning screen is generally we look for companies with ROEs greater than their PEs, their price to earnings ratio. So we want to find companies that their return on equity is greater than their price to earnings. And at the same time, we will also play themes. One of the themes we currently are pursuing is we believe certainly the next 5-10 years, there's going to be a huge shift of substituting from oil to gas and natural gas, and so we're looking for companies who can take advantage of that.
So following on down our talking points then, if the firm makes a decision that stocks are a good place to be and return on equity is higher than the PE ratio in an industry, you're then going to start to look at specific companies maybe with that industry. But in your case, you're also taking into account in the energy business this big theme, and that kind of moves me to our second question here on the screen. What are your general views of the U.S. energy markets and companies over the next several-year horizon? And you kind of hinted at it, but how do large discoveries of shale gas and oil fit the picture?
Well, the major piece in all of this is the BTU equivalent between natural gas and oil, which is from a barrel of oil to an MCFE of natural gas has a 6-to-1 ratio. So what most people are used, if we ballpark today's gas price at $4, 4 times 6 gets you to 24. That MCFE is equivalent to a $24 barrel of oil, versus if we ballpark the oil right now, it's about $100. So natural gas is right now 4 times cheaper than on a BTU basis than its oil equivalent.
That seems like quite a difference relative to history. Do you think that's a sustainable trend?
Long term, it's unlikely that that's sustainable. Prior to the shale revolution that the U.S. is going through, that ratio generally hovered around 7-to-1. And right now it's, 7-to-1 adjust, yes, so it's 6-to-1 to oil equivalent, the BTU equivalency, that's generally added 7-to-1, but knowing that gas is 4 times cheaper, that means the difference between gas and oil if you just look at the MCFE price to oil, $4 versus $100, that calculation gets you to 25 times. It's a little bit confusing because I'm mixing ratios here.
But what I think I hear you saying is that natural gas on an energy equivalent basis has gotten to be significantly cheaper than it used to be, and is certainly getting into a parity with oil. Is that what you're saying?
There is strong incentive for companies to substitute natural gas for oil. Yes.
And thinking about that then as a longer-term trend, what does that lead Muhlenkamp to think about in terms of investment? What kinds of themes does that generate as you look at your companies to pick from as investments? They're not E&P companies, but the two of the companies in particular that we like and we have in the portfolio is Fuel Systems and Westport Corp, which is Westport makes natural gas engines, and they are in a JV partnership with Cummins Engines. And then Fuel Systems and Clean Energy. Fuel Systems does engine conversion kits, and Clean Energy, they're the folks trying to open up and put
natural gas stations across the U.S.
So rather than really investing in the producers of natural gas or the exploration companies for natural gas, you're actually playing at the very end of the downstream process with end users. Is that correct?
We struggle with trying to predict the future, and so we're never sure where prices are really going to go. We believe that ratio, so one way or another, there should be a convergence between oil and natural gas in that ratio BTU equivalent basis. However, we feel a lot more comfortable trying to play volume. And so rather than trying to play the price of natural gas or the price of oil, we are more comfortable playing companies who will take advantage of volume, like the companies who are in JVs to build engines, or companies who are building engine conversion kits, or companies building out natural gas stations.
So the companies that you're interested in are companies maybe that are involved in, I read recently an article about the Los Angeles, California bus conversion project where all their buses now run on natural gas. That something like that then, right?
Yes. Yes. However, we do own some energy E&P companies. One of our bigger positions is Rex Energy. They are a company specific to southwestern Pennsylvania and Ohio, and they have some sweet acreage in not only the Marcellus but also Utica. And they're still early in their development process. So they have one of the popular ways of looking at a company is what's called the RP ratio, which is the ratio of production versus reserves divided by production. And the reserves of Rex Energy divided by its production last year, that number is over 100. So assume if they don't produce any, if they would stay consistent with what they produce, but they're not going to, they're growing their production probably close to over 50% a year. They have 100 years of 2012 reserves of production.
Wow. Tell us, for those of us out here in New Mexico, a little bit about what you've seen in the Pittsburgh area with the Marcellus Shale. Has there been quite a boom in terms of people buying mineral rights and development?
Well, the land grab is mostly over. However, the continuation of the whole phenomenon is, unemployment's coming down. There is certainly a lot of service work to be done. And however, as you suggested, the land grab is mostly over. The acreage is, at this point, the acreage that various companies have, the companies are generally pretty good at swapping with each other to create better units that they can drill with. And a unit being a certain amount of acreage that now they send in all their applications and fill out all their endless forms and that come with the whole process and licenses.
It's been quite a boom, I think, in your neighborhood in general, though, wouldn't you say?
Yes, it has. And one of the things that we've struggled with investing in E&P companies, and particularly the natural gas guys, is they have been victims of their own success. The Marcellus folks, have gotten so good at increasing production and cracking the code to get more and more gas out of the ground that it really has made a big difference in dropping the price of natural gas.
And so hence you're thinking as an investment firm, rather than buy into the falling commodity price with ever larger amounts of reserves on companies' books, it's better to play the infrastructure side of the equation with engines and filling stations.
We like to have a foot in both camps, would be a little more accurate, but and we do favor the more volume plays.
And that's why you do have Rex Energy as a
yes.
holding. Although Ken, you don't currently hold, doesn't sound like positions in a large integrated E&P company like ConocoPhillips. Talk to me just a little bit about how you as an investor would look at some of the differences between a ConocoPhillips or a Chevron, a global, fully vertically integrated E&P player, although I guess ConocoPhillips has sold off its refining division last couple of years. But compare that to a pipeline company or a natural gas company. Do you ever stop and look at the differences in those companies, or are they you treat them kind of as all one lump as a segment? How do you look at those differences in companies? Because some are more utility-like in nature than others, obviously.
Yes, and to the level that it's utility and you can have confidence in their cash flows, that would dominate your investment approach and decision as to what kind of returns you can expect. In general, we're looking for companies with ROEs over 14, which means we want companies who can invest their own equity and get at least in a 15% return on the book value that they're investing. Now, when you start comparing across companies, E&P is the energy sector is a little different than other sectors, but for the most part, this is where the art of investing comes in. There is so many ways to look at companies, and you could value them on a price-to-earnings ratio, a price-to-cash flow. Some companies don't have earnings or have very little cash flow, and you're pricing them off of sales, and then there's some modified cash flow, and particularly when definitions end up being everything. And when someone's talking cash flow of any particular company, you need to be clear of what you're talking, because most people actually have much different definitions of what cash flow are.
And sometimes what the market may think it means and what you as a chartered financial analyst might think it means are two different things, but the market rules. Is that a fair statement?
Yes, and I would say you will find chartered financial analysts defining it differently. And then some people focus on free cash flow, which is cash flow that they have available to invest versus cash flow that's already committed to either debt or possibly even to projects already.
But in your case, that return on equity hurdle of 14 to 15%, that's a bar you're going to apply as a standardized test
Yes.
for really any of your investment choices. Is that true?
Yes. We like to focus on growing companies, and yes, we're looking for companies who can get at least a 15% return on their equity.
If there's a lot of market volatility, which there has been over the last couple of years, how does the role of the dividend income stream in a pipeline company like Williams? I know I have at least one student who works for Williams. How does that factor into decision making as an attractive component of investing for a firm like yours?
For us, dividends play a lesser role. Many investors focus on dividends. For us, it does show a level of the company returning money to shareholders, which is a definite positive. However, we are mostly just as happy if they would be buying back their own stock, or at least making a prudent decision between whether they can get better returns on their stock or they give it back to the shareholders through dividends.
Okay.
So if they have mostly, if a company has a high ROE and has high return on investments, we would prefer them investing their money in their own stock and buying back stock. If their returns on their equity and their returns on the investment projects they're looking at are low, below 10%, we'd rather have them give it to us in dividends.
So if they have the high ROE like you'd rather not have a dividend, but rather have an increasing share price because there's less float available in the market.
Yes.
Okay. Ken, before I click to the next slide, one other question that you and I talked before about on the phone. As an analyst, you get lots of investment ideas brought to your attention. Our students are learning about the buy side and the sell side. You're obviously on the buy side, but where do you get information from about companies? And for example, a company like Westport, where you've learned about their conversion joint venture partnership, where do ideas like that come from? I'm sure some of it's your own research maybe, but where else do you get information, and how do you do research?
Generally, ideas come from a lot of different places. It could be articles you read in business magazines. Sometimes it's conversation with colleagues, and sometimes it's also the street, the sell-side analysts oftentimes are recommending companies. And generally, however it comes to me, once I decide that a company is of interest and I want to look into it, the first thing I do is go to the sell-side street and probably pull down 4 or 5 different reports on that company if they're available, and I read the reports, and then that gives me my first level of how interesting the company is to me. Am I still interested after reading those reports? Then the next level for me is going to the company website, and most companies are wonderful in offering presentations that they've recently done that are a great way to learn about the companies. And at the same time, they would also have the conference call webcast that you can then listen to and get a sense of what management is trying to do, how they relate to things, and also, for me, it's how promotional I think they are. And promotional being a negative. Will they be candid with you, or are they just giving you the dog and pony show?
Do you still find companies giving you the dog and pony show these days?
In the E&P space, almost all of them do it. And so it's difficult to make those distinctions. They, in particular, except for the integrated companies like ConocoPhillips that you had mentioned, most of these energy and exploration companies, their business model is to be bought out by the integrateds. They're trying to get out. They're trying to prove their reserves. It's like Rex Energy and a lot of others. They're less worried about having cash flow now or whether or not in actual this year, because energy prices are down, drilling less. They're more interested in proving their reserves and being able to go to a ConocoPhillips and say, look, we have 100 years of reserves. This is what we think our valuation is, and pretty much selling to larger companies.
Interesting. So the smallers are intentionally grooming themselves for sale to the largers then?
Yes, and by definition it makes them very promotional, and more so in the energy space than any other sector I know.
Interesting. All right, well, let me advance our next slide here and spend our last few minutes, Ken, this evening thinking about the world that you live in of investment analyst, being a security analyst, money manager. I have students, several of whom are working currently in registered representatives' offices as associates and supporters, and there's clearly a difference between a broker and a security analyst like yourself, but you have an interesting job, it sounds like. You see a lot, you read a lot, get a chance to think a lot. What would you suggest if someone were interested in doing a career track like you've done? What would they do?
If you're going to go down this career path, and fortunately for me, I love what I do. It certainly makes it easy for me to sift through companies and the financials, and learning about technology is always an interesting part of it. And it really, one of the struggles here is it takes several years to get a security analyst thinking properly that they start adding value. And so there is this definite learning curve, and so it's more of a, for people wanting to break into the business, you have to just find an open door somewhere, one way or another, and you start working and learning your craft, and it takes time. And with, one of the things that is also a struggle in the academic world is the academic world, of course, pushes efficient markets. And if the markets are efficient, there's no reason to have security analysts, or a lot less reason to have security analysts. And obviously, being a mutual fund, and we believe we can outperform, we do not believe that the markets are efficient.
So there is sometimes a difference between the fair market value and the actual market value, in other words.
In the short term, yes. In the long term, we think the market is reasonably efficient, hence if you can find the unloved company, or the company that is being beaten down more than usually what we've come across, beaten down more in the value, the price of what we believe the company is being underpriced, hence the opportunity. And that also opens up for us, the volatility in the market is really just opportunity. For the most part, as far as investors go, the only thing I want to do the rest of my investment career is buy fear and sell greed, and which means when you have a lot of people and you have a lot of news out there and it's fearful, you probably want to be a little more aggressive in your investing. And when things are running a lot and doing well and everyone's talking about a new economy, that's probably when you want to be a lot more conservative.
So it does take some courage and some fortitude. In terms of basic class background, I assume finance and accounting classes and real proficiency in those two subjects are important?
Absolutely. The understanding the accounting is essential, and certainly the financial end is also very useful, because you really do have to be able to look at companies so many different ways, whether it's price to sales, price to book. Then there's also some of the parts, which you'll often run across in the energy and exploration companies, that a lot of the sell-side analysts will break down a company and all its acreage at various places and do calculations that will tell you what they think the sum of the parts are.
So you better have those two basic building block skills well in hand before you embark on the career. And the last question I've got for you, Ken, I noticed we were going to be talking to the Edward Jones sell-side analyst for oil companies here next week. He has a designation similar to you, something called a Chartered Financial Analyst. Share with me what exactly that means and what you have to do to earn that credential.
In general, it's my interpretation is it's Wall Street's version of a CPA. And so Wall Street will, the Chartered Financial Analyst, there's 3 tests. You take one a year. On average, the average taker has an MBA, studies 200 hours, and fails. So it's a pretty rigorous test. There's 3 levels to it. And once you get through all 3 levels, then you earn your certification.
So it's a tough credential to have, but if somebody has it, you probably have reason to believe if you're hiring somebody, they've got some skills?
Yes, and that is a CFA, at least from an analyst perspective, is going to be much more meaningful than an MBA.
Okay. Ken, any final thoughts on either the energy business or your role as an analyst for our students tonight?
Another way of looking at companies is also trying to get a good sense of the management. And in particular, since we are addressing the energy end of it, I've run across many people who have been in the business a long time, and when they look at energy companies, they actually like to focus on the track record of safety. They think that if you can find quality management, and one of the signs of that would be a good safety record, that from there it's difficult to truly know the managements in particularly like energy and finance is energy and finance does excuse me, there is I lost my train of thought, forgive me.
Well, we were talking about
yes.
You're saying there's a linkage between quality of management and the safety record of a company?
Yes, and there are many people, it's difficult to know truly what they have, and the management probably is much better assessing that than we ever could be. So particularly with the energy company, same thing with biotech. It's the management and the scientists who truly know what they have, trying to figure out and better than what their knowledge and be better at it is quite a challenge. So you're better off trying to figure out whether or not you think they really know what they're doing. Just
well,
like
it's interesting you mentioned safety. I know here in the San Juan Basin in northwestern New Mexico, where I live and several of the students do, the companies that we're tracking, ConocoPhillips being the largest here in our basin, running 15,000 out of 20,000 natural gas wells in this county, has really, really ramped up focus on safety. And if you're a vendor to that company, you need to plan on 40 to 80 classroom hours before they even let you set foot on a well pad site of theirs. I think there's definitely a connection with that. And I think the BP disaster in the Gulf several years ago certainly sharpened that focus for everyone in the industry. Even if it's a small onshore single natural gas well, it still can cause a fatality.
Incredibly expensive to BP, and no energy company wants that or can afford it.
Yeah, exactly. All right. Well, hey, Ken, I thank you very much for your time tonight. What I'd like to do is I'm going to go ahead and wrap up our interview, and I'm going to call you back on the cell phone and wrap up with you, and wish you a good evening. I'll be back to you here in just a minute, okay?
Thank you.
Okay. Bye-bye.
Have a good evening.